Okay, I think we can go ahead and get started. We're about a minute after. Um, Good morning or good afternoon, depending on where you're listening from. I'd like to welcome you to our PLP refresher training. We have I guess, a group of both farm loan staff and lenders on. As I go through this, I'll try and be conscious of, who I'm speaking to or referencing, but, sometimes it's, I get on a roll and it'll get mixed up, but I think you'll be all right. What I'd like to do is go ahead and take care of some, I guess, opening comments and I guess general housekeeping issues. So let me go ahead and, Matt, if you'd go ahead and switch me to PowerPoint. We're doing this in Microsoft Live event. And it's slightly different than Teams, but very similar. If you've used other products, then, it's got a lot of the same features. The length of this training, I guess we're based on Tuesdays, we're probably looking at a little over an hour, no more than an hour and a half. I got about 35, 40 minutes presentation, and then the rest just kind of depends on, how many questions we get. We will have plenty of time at the end for questions. I guess to introduce myself, I'm Steve Ford, a senior loan officer with the Guaranteed Loan Making branch, and I'll be doing the presentation today. The participants, all of you are muted, just to kind of avoid some of the background noise when we get up to this many people on. There's, inevitably there's some background noise, and this live event gives us the ability to do that, so that just helps everything. Since you are muted, if you would type your questions in under the Q&A button. If you look on somewhere around the top right of your screen, you'll see Q&A, and if you click on that, it should open up the Q&A bar where you can type in your questions. And we'll respond to those both during the presentation and we'll have Q&As posted after. In addition to that, we are going to post a recording of one of these, either Tuesdays or this one, whichever seems a little bit, more polished. And the slides will also be made available to everybody. So I'm going to go ahead and go to full screen here. A little bit of background regarding this training. This kind of originated back when we had a beginning farmer lender summit, and what that was, the department put together a group of both beginning farmers, other stakeholders, and a lot of lenders through the lender associations. A collection of those, along with some agency staff, got together and divided up into work groups and came up with a collection of recommendations on how the agency can better serve beginning farmers and generally improve the programs to accomplish that. As a result, a number of recommendations were put forward, and as one of them, one of the overriding themes is consistency. Lenders are in a unique position regarding this. Producers typically work with one office, but lenders are in a unique position depending on how much territory they cover. They can work with multiple county offices within a state, or they can even, work with multiple states. And, inevitably when you do that, they're going to run into differences in approach, differences in just certain policies, practices, and customs from the different offices. And honestly, we understand that it would be frustrating. It's not that they have a strong opinion necessarily, but just, let's be consistent on things. So that's something that we are going to continue, not just with this training, but ongoing, is to strive for better consistency. One of the other things that came out of the Lender Summit, and one of the recommendations, was to have more of these joint FSA lender trainings. And we did this, it's been a number of years ago, but for about 2 or 3 years running, we had a series of these where we would you know, do each of these and do just kind of bite-sized training sessions. It doesn't have to last half a day or anything, but, just bite-sized topics where we get both FSA staff and lenders together for a training session, and everybody, can hear the same thing at the same time. And with the Q&As, we can, get a little better, just coordination as to each other's concerns. So we're leading off with this preferred lender refresher, the PLP refresher training. We do have plans to continue these, and a couple of the other requests were for a dedicated session to beginning farmer programs. How can we use our direct loan programs along with either the lender's guaranteed financing or even non-guaranteed? How can we pair that up and use some of those programs together? And also, as best we can, try and clarify who is a beginning farmer. In addition, some more guaranteed loan making practices and issues, certain hot topics for guaranteed loans in general, not specific to PLP, and rolling out some guaranteed loan servicing training also. There were a number of other recommendations from the summit, but it's going through all those is a little bit beyond today's training. So anyway, today's topics, and this kind of gives you a little bit of a high-level view of what we're going to be covering today. A lot of it's going to be dedicated to the PLP application, and in particular, the loan narrative. That's, one of the big areas. As far as loan making, we have two just big, broad things that are different for PLPs. There's a number of other small ones, but the application, both what the lender would get from their customers and also what they would submit to us, is different, and capacity. Those are the two, big areas where we've carved out differences for PLPs on the loan making side. In addition for today's training, application processing and best practices, both for lenders and for FSA staff. That's going to be an ongoing thing that we're going to try and work in with, all of these, is just have a little bit of, what are the best practices going forward. So, and again, as a just underlying, theme to this whole thing and throughout the year and forward is going to be trying to strive for better consistency. Now, before we get rolling too far into this, one phrase that you're going to hear me say quite a bit is either credit management system or CMS. And this is kind of a back to basics thing, but this is, really the key of the preferred lender program is this credit management system. And right here is just a general picture of what it is. This is a document. It's probably about 15 pages long, give or take. And what it is the lenders submit this to us and tell us how they are going to make the loans. So as a lender, it could be somebody else in your bank negotiated this with us, and we sent them a copy with the intent to have this distributed. And hopefully you're familiar with it and you have it handy. But it's going to look like this. If you haven't looked at it, please do. It's going to have that same look and feel on the front page here with the title. It's probably going to be exactly the same thing. Your bank and city is going to be right below it, and the lead-in paragraph. Now, after that, we're going to have some of these categories, but this is unique to each lender. The language in it's going to be, a few boilerplate things, but mostly this will be unique to each lender. So, anyway, when you hear me say CMS or credit management system, this is what I'm talking about. So lead off, like I say, one of the biggest differences for PLP is the application. They don't have to give us nearly as much, and they tell us what they're going to collect. Up in the, I guess, top of this slide, you see the highlighted language there. What this is just the language straight out of our regulations, 762.110. And it says that PLP lenders, the application is going to be an application form, a narrative, and whatever else we essentially negotiate with them during the origination and renewal process and is in the lender's agreement. A lot of this is going to be, in the loan narrative. Some of it, you see my asterisk there, this includes environmental information. So we do need, depending on the loan type, we will need some additional environmental information depending on what you intend to do with the funds. Sometimes, the application and narrative will be enough. We can just, do a categorical exclusion for a lot of the environmental. Other times, if you're going to do some, ground disturbance or have a building, then we may need more. But two things we need are the application form and the narrative. Now, this is what is in our regulation. And at the bottom of the slide kind of gives you an idea of some of the things that is going to be contained in this CMS that I asked you to, grab and read. The CMS is going to define what a lender is going to gather from the applicant. And it's going to, have some language in there regarding how many years and how old a balance sheet you're going to have in the file. What are the years and types of income and expense history? Do you use their own? Do you require tax returns, et cetera? How far back? For what, categories of loans? And, it's going to, list in there if it's a small loan, you probably gather less. Similar for production history. What's your policy on verifying debts and assets? Just because, we require, anything over 5,000, you may have a different policy. And that's something we work out with the lender when we're developing and negotiating out this credit management system. So they're going to tell us what their policies are, and we're going to put it in there if, however we agree to it. Also it'll contain, how old a credit report are you going to have in the file? So that's what is going to be in the CMS, is what you gather from what the lender gathers from the applicant. Right here is, this language that I have on the screen now, this is going to be in nearly every CMS you see out there, a version of this, and it'll look very similar. And this is what the lender is going to submit. They're going to submit an application. 2211, we're down to one form now. So you got one form to submit us, and you got a loan narrative. A lot of those things, below there are just general references as to what should be included in the narrative. 5 C's, eligibility information, loan purpose. We do need location of the farmland. We take care of a lot of behind the scenes stuff if we just know where the land's located. The other thing in the narrative is entity information, describing what kind of entity, who's involved, and how it's structured. So I guess just one comment, the next several slides are going to go through the narrative. And the reason I'm focusing on the narrative so heavy in this training is we put a lot of weight on the narrative. And, it seems to be, whatever's not on the application form, or if a new requirement comes out, then we always say, well, the lender should describe that in the narrative. Well, again, there's a lot of stuff that we put on the narrative, and that's why, a lot of this training today is going to focus on what should be in there. Question, just kind of a frequently asked question we get, from lenders when they're inquiring about or, renewing their PLP status is, how can I limit requests for more information? And the answer is, like I just said, a good quality, thorough loan narrative is going to go a long way toward this. And, it's not necessarily length. It's knowing what we need to see and what we need to answer our questions. There's a lot of eligibility stuff that you normally wouldn't, lenders normally wouldn't, think about putting all that stuff in there regarding our eligibility. As far as the 5 Cs, as lenders, particularly PLP lenders, you're probably pretty good at the 5 Cs of credit. You can walk somebody through the capacity, collateral, credit history, those, but some of the unique stuff that we need for, our decisions, because it's a guarantee, is what I'm going to go through here. What I have here is it's not 100% complete checklist, but it's a pretty good screen if you want to print something and save as, a checklist. These are the things that definitely need to be addressed in the loan narrative. Like I say, down at the bottom there, you got the 5 Cs, which, generally you're familiar with, you do anyway. And you've probably gotten pretty good at it. Use of loan funds, rates and terms. Yeah, that's going to be in there. We haven't had a big issue with that. Entity description. I think we've at least got we usually get a pretty decent start on that. Location of farmed land, that's something to, just be aware of. And, I understand you probably got, certain practices worked out locally, if everything's the same, they may have it at the FSA office anyway. But the biggest thing is the one on top there, eligibility. And where that comes in is the operation background and description. So that's what I'm going to, focus on a lot. Just before I get to it, one thing that we do have available to you is the Lender's Loan Narrative Guide. And this is in our handbook, 2FLP. It's Exhibit 4.5. Handful of pages long, but it does a really good job of walking through how to do a good narrative for us. And it's got some bullet points on what are we looking for, and even situations where we describe, okay, in this situation you probably don't need to give us as much, but here are the situations where you might want to focus and give us a little more detail. So this is a really good product, and this is on our short list to update sometime this year and get a I guess an updated version of this out to you. Okay, in the narrative regarding eligibility, and what I've done is divide this up into essentially 3 categories. We got a number of eligibility rules. Let's see, 4, 8, about 10 or so eligibility rules, and I've divided these up. The first slide here is the 3 must-haves. These are the 3 things that if you don't address these, or if it's pretty sketchy and incomplete, we're probably going to have to come back to you. We're going to have to come back to you with questions. So the 3 of those are in what these are. The reason these are the 3, what I would call the 3 most important for a narrative anyway, is you're our only source for this, you being the lender. Some of the other stuff, yeah, we have some databases to search and, things like that we can look at, but you're the only source we have a lot of times. We don't have, as many offices. They cover larger territories for the farm loan staff. A lot of times we're not familiar with that particular operation, or the person or family or so forth. So you're our only source. A description of the operation, and what we do is use that to answer are they an operator of a family farm? Credit history, we're relying on you for that, and the need for the guarantee, what we call test for credit. So those are probably the 3 most critical to address thoroughly. On this slide, again, you're our main source for this, but they're not frequently not as they don't come up as often as far as being an issue. Are there any outstanding recorded judgments, legal capacity to incur the loan? We rely on you for that, but it's not an issue as frequently. Controlled substances, and citizenship. With these, a general reference that, they meet these requirements, or, you've considered these and nothing applies, or there's nothing negative here. That's usually suffice, but, don't ignore them. But the biggest thing is, if you know something on any of these topics, describe it in the loan narrative and we'll take it from there. And the last group are, their eligibility things. Technically, a general reference will be fine, but generally these are things that we can check on our own. If they had an agency loss, delinquency on federal debt, past dealings and crop insurance violations, we can check on these. Obviously, if you know something, yeah, mention it in the narrative, but generally we got our own sources to take care of these. So if you would just remember, first of all, definitely remember the first three, and particularly description of the operation, and also these, just recognizing you being the lender, our only source or main source for this. So digging a little deeper, one of our eligibility things that we have to sign off and certify to are that they are the operator of a family farm. And there's a lot of stuff that's worked into that phrase. And really, we have to answer these three questions toward the top of the screen there. And we're relying 100% pretty much on your description of the operation. One of the things is, are they an operator? Is the operation a farm? And is the operation family size? Those are three ways to break that apart. What we need from this description of the operation is, first of all, who's the legal operator, and also who's the physical operator. If it's a formal entity, is it a formal entity? Is it an informal entity, like a joint operation, or is it a sole proprietorship? And the way to kind of think about who's the legal operator is, the paperwork and the money flow. Whose name's on the leases or contracts, what name are the bank accounts under? When a grain check gets issued, whose name is it on the grain check? Is it an LLC or is it the individual? So, that's one way to think about the operator. The other way that we definitely need information on is who physically operates the farm. What individuals provide the daily labor management and also the longer term strategic management. And if it's an entity, describe the owner's roles in the operation. What contribution do they have for labor? Make sure you include that. Second question is the operation of farm. Generally, what do they produce? They need to produce an agricultural commodity in sufficient quantities, so a lot of this stuff, this kind of leads me on a bit of a tangent, but you got to understand a lot of the stuff, when we, for an SEL or for our other loans, we would typically get a balance sheet and at least some kind of a cash flow. And there's a lot of stuff we can gather to answer this family farm issue if we have a balance sheet and cash flow. But we don't get that from a PLP lender. And that's where we're relying on this operation description. So, if you have a cash flow, you can kind of tell, okay, what are their total sales, and from what products, things like that. We don't get that. So that's where you need to work some of this into the operation description. They must produce a commodity for sale. They can't simply just purchase and resell. It has to be, at least a majority of it needs to be produced by them, before they would sell it. What commodities or products, do they produce, and is the commodity an agricultural product? Yeah, most of the applications we get, it's going to be pretty obvious, corn, beans, wheat, cattle, hogs, or poultry. But, we do run into, some unusual things, and best thing I can tell you is if you got something you're unsure of, that'd be a great time to call the local office before you, get started on the application, run it by them. Last thing on this operation description part of the narrative, is trying to describe a little bit of the size. What we look at in terms of is it family size is probably the biggest thing is how much labor is contributed by the family members versus how much, do they have to hire out. Also a little bit of something to put this the size in perspective, whether it's acres or quantity sold, head of livestock or dollars, revenues and so forth. And what we do is we compare that to typical family farms in the area, and try and get a comfort level that, yes, this is a typical family size farm. And as you're probably aware, this is going to be, region specific. Things to include in the narrative, down at the bottom of the slide, like I had mentioned, revenue, quantity, owner families involved, what's their labor contribution, any other special factors. Okay, on the big three, the second one I had was test for credit. And really answers the question, why do you need the guarantee? And this is one of our eligibility criteria that, you have to certify and you have to demonstrate that you need the guarantee. This isn't something that we are going to be, we haven't been and aren't going to be, extremely hard on. We've always been very flexible on this, but, as lenders, you're all familiar that, look, you got people looking over your shoulder, and there's some things you do, to try and document it because auditors are going to look at it. Well, we're not a whole lot different on a lot of that. And this is one of those areas that, we're trying to do a better job of documenting some of this than, long ago when we, may not have. In your lender narrative, the best thing you can do, is the top bullet there, compare it to the standards in your credit management system. If it doesn't meet a standard, that's probably why, you're requesting a guarantee. So mention, what it doesn't meet. Here's some examples, on that second bullet. These are just some examples of some weaknesses that, I just thought of in about, 30 seconds and put them down here. And certainly you can come up with, a weakness because you're filling out this application, you're going to that effort, you're going to pay or charge a, guarantee fee on it, probably. So there's a reason you're doing it, and just go ahead and put it down and, you should be okay. Down at the bottom of the screen there, just something to consider. If an entity member has a second home free and clear or some other asset free and clear, would taking that as security remove the need for the guarantee? And if so, you need to consider that when you're describing this. Entities. Just one brief thing, and we work this in with I think we work this in with every CMS we have coming through now. We have a phrase very similar to that the lender will consider the financial resources of each member when determining the need for the guarantee. So, if you have one of the members is a multimillionaire, give it a second thought. Do I really need a guarantee on this? If you do, you do. Just describe anything related to that or relevant to that in the narrative. Another question on this test for credit, just real quick, secondary market. Just selling on the secondary market alone, that doesn't demonstrate a weakness. What you need to do is you need to show how is this going to benefit the borrower, and typically it's going to be, longer term fixed rates, will help them achieve their goals. So make sure you work in something a little more thorough and not just relying on the, handful of words there selling on secondary market. So. And on this slide, and you can read it more detail later, but, these are just some of the acceptable or some of the things we're looking for. So you got a better idea, in the top two, really just compare, what the current standard is versus what the applicant's financial measures are. And the other one's just kind of getting across what I just mentioned about the secondary market, trying to tie it to an actual weakness and, describe the benefit to the borrower. And the last one of the big three regarding the eligibility is credit history. Again, we're relying on you to tell us what's acceptable, what's not acceptable in credit history. The biggest thing on here, don't be silent on it. Discuss it, we don't need, if there's nothing to say, or I mean, if it's positive, you shouldn't, have to say a whole lot, but, give us a sentence or two on it. Particularly if there are negative things on the credit report, really right in the middle of the slide there are the two questions that we need you to somehow address is how are these beyond the borrower's control, and why is this no longer a concern? Has the problem been removed? So, those are the two questions to answer if there are, things that are negative. If it's positive, you can be very brief, just a note, but, don't be silent on it and do, have a sentence or two on it at least. Okay, that takes care of the eligibility stuff. The other part that I'd like to talk about in a couple slides here is the repayment capacity. That's the other area that we've really carved out something unique for PLP lenders. The top highlighted language there is what's straight out of our CFR, our regulations regarding repayment capacity, and just essentially says PLP lenders will follow their internal procedures as agreed to by the agency during PLP certification. And again, this goes back to that same document that I'm showed you, is the credit management system. And that's going to detail out how the lender is going to evaluate capacity. Now, one thing for, I guess, our staff to pay attention to is when we do this, the lender may not use exactly the same methods that we use for evaluating capacity. Sometimes they may use a projected cash flow, which is our traditional method. That's how we do it. A lot of times they will in some manner or another, or at least for certain loans. If they do, a lot of times they're going to use their own planning prices. That's fine. They don't necessarily need to use our planning prices. If something, and on the lender side, hey, if something seems, particularly unusual or different about the prices, that'd be a really good thing to address in the narrative is, what's your source? How'd you come up with this price? The PLP lender can use their own projected yields. Again, this should be supported in the narrative, particularly if it's going to, raise any, I guess, catch anybody's eye or raise any red flags. Describe, how you arrived at that. Same thing for historical income and expenses. The other thing to really, back on this historical income and expenses. Sometimes a PLP lender may not necessarily rely on a projected cash flow. It may be more on historical income and expenses. And if there are no changes to the operation, a PLP lender may rely on that. The last thing I'd like to mention is this scorecard underwriting. PLP lenders can use scorecard underwriting. Typically, not every lender does this. A number and a growing number are doing this, for some loans. Typically, it's, the smaller loans, and each lender is going to have, a different threshold, whether it's under 250,000 or 500,000, whatever the threshold. And we, should have that described in the CMS as, what loans they can do this on. But again, for the PLP lenders out there, that's something that, describe it to us, describe, what the score was, that it does meet the whatever your threshold is, and it does qualify as a loan to, be under the scorecard underwriting method. So, and that's what you would include under the capacity part in your narrative. All of the credit management systems, are going to have a statement similar to the lender will not approve a loan that projects less than 100% repayment. I think for the past, 5, 8, or however many years, we've been putting that phrase in there. So for lenders, just be aware of that. Most CMSs have the phrase that you're going to describe. If capacity is considered a weakness, for example, if it's, in the language I have down below, if it's, below 125, 1.25 to 1 coverage ratio, it's considered weak and you should have an offsetting strength. That's what you need to describe in the narrative is, what's the offsetting strength? So, and that's what our staff is going to look at. You're going to put down what your coverage ratio is. We're going to see that it's below, and there should be a description of, okay, why is this not a problem? And, what's the offsetting strength? And again, this is just, if you're looking for, I guess, somewhat of a checklist, this kind of walks you through that, assumptions used, offsetting strength, strengths, weaknesses, include your confidence level in the forecast. That would be a really, really good thing to have. Sometimes, you can back things up, with it, you have a very high confidence level that they're going to achieve this, or, what are your concerns? Another thing that has come up, another question we got, second to the last thing there, if the first year is not positive, discuss how you're going to get to a typical year. Maybe you're going to rely on current assets, or maybe you got unequal payments. That's something to describe to us. Not to say you can't make the loan, but how are you going to get from here to there? How do you get to a typical year where things are going to be working consistently? Next, moving on to collateral. Just a statement here that the collateral rules we have, they're the same for a PLP lender and any other lender status. The lien position rules, they all apply to all guaranteed loans regardless of the lender status. Some examples of those would be, we need an 85% loan to value if we're going to take a junior lien on real estate. We have restrictions for taking junior liens on chattels. The other thing you should be aware of, that we do need you to take additional collateral when it's appropriate. And we recognize that this is going to be, situational dependent, number of factors that you would consider. Discuss in your loan narrative, what additional collateral was considered, and if you don't take it, why wasn't it taken? You probably have a reason, and, maybe definitely, whatever your reason is, just tell us, hey, we considered taking this as additional collateral, but, for, this reason or that, you elected not to, and so forth. So that's just something to describe in the narrative. Appraisals. PLP lenders, you must use the same appraisal rules. Generally, real estate appraisals over 250,000 needs to be USPAP and by a certified general appraiser. One exception we do have is if you use an old appraisal, anything over 18 months, the PLP lender doesn't need to get our prior approval, but they still need to document in your file that the criteria in 2FLP are met. So be aware of that. It's not a bad thing to let the FSA office know, about some of that, but anyway, that's one exception on the appraisal issues. And just a final note that appraisals, they do not need to be submitted to FSA. The CMS is typically that's going to have a list or description of what your acceptable loan to value rates are for different collateral. If it's outside of those, that's where we'd be looking for offsetting strengths. You're probably, for the most part, I think you guys, lenders are pretty good at that. Describe your method of valuation. You using an appraisal or evaluation? And if the loan to value standards are not met, but it's still fully secured, what are the offsetting strengths? Just a couple slides here on best practices. And these are some things that came out of the Lender Summit that I'd like to, I guess, talk to both lenders and FSA staff about. For the FSA offices, when you get an application, make a complete list of the items needed. Don't piecemeal this out, and make sure the list is complete. Spend at least a little time doing a quick read through. I mean, for a PLP lender, there's not a whole lot of, separate documents. You got an application and a narrative. Outside the environmental information, you probably just have those two. Now, you may have some extra questions. Spend a little time before you, fire off an incomplete letter and see what else you might need. One of the complaints we had through the Lender Summit was some offices would piecemeal this out, over the course of a week. I need this. Oh yeah, I need this also. Try and avoid that. Get an email to the lender or a call as soon as possible, and then you can follow up with the 15-day or with the incomplete letter. If you have questions after reviewing the application material, preference, call or email the lender with the specific questions rather than just relying on the incomplete letter. A lot of this stuff, particularly with PLP lenders, these are the lenders that we should have the best communication relationship with. We should be able to take care of a lot of it, just with quick calls or quick emails. You can use the lender's response in the email or just document what they told you in the call. You don't necessarily need hard copy documentation for every little issue. When do you need physical documentation? Again, unless it's absolutely necessary, you take the lender's answer and just document it. Sometimes, I guess the answer to that question, sometimes it may be easier for the lender just to give you the source documentation, and say, hey, how about if I just scan this in and email it to you? That may be easier for the lender. Okay, in that situation, it may be okay just for it to end up in the file. But generally, most of the stuff you should not have to require a balance sheet or cash flow to decide. Yields seem high, prices seem too high, whatever. You can address that specific issue without getting a full balance sheet and cash flow. It should be extremely rare that you need to get one of those, and definitely it should not be a pattern where that is required. Now, having said that, and I'm speaking to the lenders now, yes, there are certain times when our loan staff is going to need to follow up and say, hey, we have a question on this. We may have a direct loan with that borrower also, and some of the stuff may not really true up very well. And that's, that's just one example where it may be appropriate for us to, call you and, discuss some of this. So anyway, yes, sometimes we're going to need more information, and, we'll try and cover that with a call or email as best we can. But certainly, let's not make it a habit or a practice or a pattern to require all this information on a routine basis. Another one from the Lender Summit is the lenders had a concern that farm loans should obtain the needed forms from farm programs rather than make the applicant or lender obtain it. Certainly, if it's a form that's already there in the office, take a step back and try and, confirm, do I really need a copy of this in the farm loan file, or can I just accept that it's in the office? You do need an AD 1026. Now, as best we can, we should just be obtaining this directly from farm programs. But, I guess speaking to the lenders now, there are some situations where, yes, the applicant's going to have to come in and either initiate or assign or sign something or do something with the farm program staff to initiate a form if it's, just not there. So I guess this is just kind of a customer service thing. As best we can, let's obtain it ourselves, but we may not always be able to do that. On the Lender Summit, another thing was trying to improve our environmental process and streamline that as best we can. About all we can tell you is we've made a lot of progress on this. If you go back, 10, 15 years ago, we've made some progress over the years in trying to get more stuff just included in what we call a categorical exclusion. There are two situations where we are going to need to put more on you as far as environmental stuff. Two things are that if there's ground disturbance or if you have large amounts of livestock, typically they're going to require more detailed environmental review. The best thing we can tell you, start anything early. Communication is key to any of this. Before you even, give us the application, contact the office if either of these two are what you're doing. And, we can kind of give you some suggestions on what you can do to try and get the process started early. I guess finally, regarding this topic of consistency, and I do have things I'd like to mention to, I guess, both FSA staff and lenders. For FSA, talk to your neighbors, local offices, talk to your neighboring local offices. States, talk to your neighboring states. You got lenders that are crossing lines. Different states and different local offices have different practices and customs. And you got to understand that is frustrating for the lender, to have to sort all that out and keep it straight. So talk to each other, as best you can, stick to the handbook, use practices when requiring, use some of these best practices when requesting clarification that I mentioned. And there's a reason I put down talk to your neighbor twice. On lenders, I guess two things to mention. One, let FSA know if something's not consistent. If you can just go to the county in a, appropriate manner and just say, hey, the other offices I work with or the other office, doesn't require this or, does it this way. Go let us know, and certainly if you can't get it worked out locally, we can't help you from a national or state level. If we don't know what's going on out there, we can't help, resolve this. So you got to let us know. And the other thing is to recognize certain information needs are going to be situation dependent. A lot of these are $1 million loans and some are fairly complex. So certain information needs are going to depend on the situation. That kind of summarizes, what we've covered today as far as the plan presentation. What I'd like to do is open it up for questions. And before I do that, or before we start reading through the questions, my contact information is, I guess, one of the earlier slides and also on this one. Certainly, if you have suggestions for future training topics or things that might make this go a little smoother, we do intend to keep doing this and pick other topics. But if you have any suggestions, please email them to me. So I guess with that, Matt, I will kind of open it up for any questions we might need to answer.
Sure. Thanks, Steve. Yeah, we've had some questions come in here as you were working through the presentation, so we can start working our way through those. And actually, the first one I think is just kind of a good one because it fits right into the some of what you were talking about. So if the question is, if you're a new or somewhat less experienced lender in terms of using FSA guarantees, how do you go about becoming a PLP lender?
Okay, good. For lenders who are, I guess, have some experience but are not yet a PLP lender, we do have, I guess, volume and loss requirements. First of all, probably the biggest hurdle is we need for you to have made 20 loans in the past 5 years, and if you have that, we viewed that as successful experience with our program. And what you need to do is contact your local or state office and start developing a credit management system. Now, we do have a sample that's available on our website. That's, I gave you the kind of a screenshot of the first page, but what that does, and you can just kind of read through it and customize it to your own policies. And, through the state office, you would submit that to them and they would, kind of package it up and send it to us for review. I guess anything else I'm missing on that initial process, Matt?
No, just one real quick thing I would clarify. Just when Steve was mentioning the loan volume requirement in terms of 20 loans in the last 5 years, just to clarify, those are 20 FSA guaranteed loans in the last 5 years. Not just any ag loans that you might have in your portfolio. That is specifically FSA guaranteed loans we're looking at there. And then, yeah, just to echo what Steve said, once you're, as a lender, if you're at the point where you feel like you meet those eligibility requirements to become a PLP lender, the main thing is just to start having that dialogue with your local office and the state office. And the way that process works is, of course, they'll work with you to verify to see if you do indeed meet those eligibility criteria. And then at that point, you would work with them to help kind of start crafting that like a draft CMS to be submitted for review. And then, as Steve said, eventually that works its way up to the national office for the ultimate review and approval of the PLP status. But definitely something to look into if you're a lender who is starting to use our program more. Definitely a lot of benefits to that. So the next one, Steve, we'll ask is the question is, how are we handling an EIDL loan, or so the SBA Economic Injury Disaster Loan? How are we handling that if one of those has priority lien position? And just to start with, I can add some thoughts, and then Steve, you can feel free to chime in. But really, to me, regardless of what the loan is, anything that has a lien prior to the FSA guarantee, we're going to treat that the same as we would any other prior lien. Obviously, if it's if the proposed FSA guaranteed loan would be in a junior lien position, then of course we'd have to look at that to see if it actually meets our requirements for junior liens. But as far as the if the lender wanted to have a first lien position, the lender would have to obviously work to get a subordination of that other loan. But Steve, you have any other thoughts on that?
Not much, other than, I think you nailed it, that we haven't carved out any special agreements or special treatment, because it's a SBA loan or anything. We would view that as, any other additional, partnership financing.
All righty. So with that, we'll move on to the next one. We actually kind of have two that are related to appraisals, so we'll maybe hit on both of those. And so the first one, I'm going to rephrase just a little bit, but essentially we'll get at the same thing, which is, in scenarios where appraisal fees may be paid for, by rolling them in as part of the loan, is there any requirements on, who the appraiser is, or, does it have to come from a list of like pre-approved appraisers?
We don't necessarily have pre-approved appraisers. We've always just essentially turned that over to the appraisal industry, where it does require a, state certified general appraiser. We don't go beyond that for our guaranteed loans. If they're on that, have an active license and so forth, we let the appraisal industry kind of police itself on that, rather than have us, try and maintain a list of, approved appraisers or anything. Was there more to that question than that, or?
Nope, that was really
Okay.
about it. And yeah, I would just echo what you said. I mean, regardless of what, whether the applicant's paying for it or if the lender's picking up the tab or whatever, like you say, we don't have a list of approved appraisers. It's just a matter of, they have to be a state certified general appraiser. And of course, the appraisal has to be USPAP compliant. So anyway, the next question on the appraisals was, why hasn't FSA adjusted the appraisal threshold? So I assume they're talking about our $250,000 threshold. Why hasn't FSA adjusted that threshold to what the current bank regulatory guidelines are?
I guess part of it, we, just haven't, gotten to the point where, enough analysis has, been done to show that we should be increasing it. We do recognize that as lenders, your thresholds for that are higher. But, on the other hand, these are, by the fact that you need a guarantee, these are riskier loans. That is something that we would consider. That 250, as far as our guarantees, was set quite a while ago. And, that is something that I guess we recognize that, we may need to consider doing that soon.
All righty, thanks, Steve. Yeah, I don't really have anything else to add on that one. So I'll jump to the next one here, and I can take this one just to give you a break for a minute because it's related to the environmental topic a little bit. So the question is, regarding the environmental information, is it necessary for an FSA official to visit the property, or are we just going to move forward based on the information provided by the lender? And again, that's really going to depend on the situation, because keep in mind there's two different types of environmental reviews. The one that Steve was alluding to earlier, when we're talking about ground disturbance and large amounts of livestock, is our environmental review under NEPA, which is, the National Environmental Policy Act. And basically what that review is looking at is, what's the potential environmental impact of whatever's being facilitated by the guaranteed loan funds. So that particular review, FSA is responsible for doing. So if it's, one of those situations that, one of those more elevated reviews are going to be required, typically, yes, FSA is going to have to make a site visit to do what we need to do to be able to complete that review. Now, separately from that, there's what we call environmental due diligence, which of course that's looking more at the suitability, of the security, and looking at, are there any potential environmental hazards there that could impact the value of the property or cause issues if you go to sell it down the line. Now that particular review, lenders are required to do that for any FSA guaranteed loan that's going to be secured by real estate. So, for that particular review, the due diligence alone, where we're just looking at the suitability of the security, so that's essentially the FSA 851 or another similar form. That particular review, like I said, that's on the lender to do, and typically, unless there's something unusual going on, there should not be a need for FSA to do, a site visit as it relates to, the due diligence for the loan security. But like I said, if it's one of those NEPA reviews, when we're looking at the loan funds and what those are being used for, if it's one of those more advanced types of reviews, then in that case, yes, typically FSA will have to do a site visit for those. And then the next one here is a real simple one, so I can just take that real quick as well. Steve had just asked, could we provide the website where lenders can obtain the most up-to-date copy of 2FLP? So 2FLP, our handbook, is available on FSA's public website. So that's just fsa.usda.gov. And then once you're on the main page, you can just, using the navigation tools at the top, you can navigate to the section that's called Laws and Regulations. And then under there, you can, among a bunch of other things, you can access the most recent copy of 2FLP and just our other handbooks that are out there as well. Just bear with me here as I get to the next one. Just trying to go down in order here. So this one will get your input on, Steve. So it was stated that PLP lenders are required to provide FSA loan staff with the application form and the loan narrative. Should FSA staff be asking for and requiring balance sheets, income statements, other underlying financials like that from PLP lenders?
Okay, the quick answer is no, with, I guess, a couple footnotes. The PLP program, when it was designed, a couple decades ago, did not envision requiring more than just, the narrative as far as describing, that it meets the capacity and collateral and so forth. We adjusted when we wrote it. It was envisioned that the narrative would just provide enough guidance for us to approve that loan. Now, there are some lenders out there with their narrative, and the software they use and the products they use to create their narrative, that, these software products will, they will roll in summary information of the balance sheet. And they will, all just naturally print out, summary information of a cash flow. And, I guess those lenders, voluntarily have decided, hey, it's easier for us to go ahead and just use this software where, yeah, it does include more balance sheet and cash flow information than we have to provide, but it's easier for us just to, include that. So we do see, those in there. It should be, again, extremely rare to have a whole cash flow or and balance sheet, in the FSA file. Typically, we should be able to answer the questions, with specifically, if we have a question on a specific topic, we should be able to, answer that specific topic and take the lender's answer, rather than require a balance sheet or cash flow. I can't go so far as to say that we're never going to ask you for, some kind of source documents. It may be easier just to, answer our questions, but for our people, we definitely shouldn't see a pattern of this. It should be extremely rare. And there should be, some kind of, documentation in the file as to why, you are needing to ask for that. But yeah, again, we really should not see that in our file, except on an extremely rare situation. And those are usually where it's just, for all things concerned, it just might be easier to answer our questions by having that. And if you got any other spin on that, Matt, certainly, feel free.
No, not really beyond what you already said, other than just to re-echo what you said. I mean, there may be, instances here and there where we have to ask for some more clarification about something, or, might need a little more detail. But, for the most part, we try to make those the exception rather than the rule, and unless there is something, very unusual about a particular case, we really shouldn't be in the habit of requesting those underlying financials from PLP lenders on a regular basis. So moving on to the next question, and at this point, I'm actually going to call on Tim Reimer, who is here in the background with us as well. Tim works in the FSA national office as well. He's in our guaranteed loan servicing branch, and we have a couple of servicing questions here, at least one to start with. So we'll let Tim answer that one. So Tim, the question is, what does a PLP lender need to provide to FSA when re-advancing on a line of credit? So I assume they're talking about, re-advancing in a subsequent year under a multi-year line of credit if they're a PLP lender.
Yep. Thanks, Matt. Basically, the PLP lenders aren't required to provide any documentation to FSA. You do need to make sure that you have the documentation as far as cash flows, your normal renewal information in your file. And that's in the case of a loss claim, that you can provide that information down the road. So you don't have to provide anything, but you do need to make sure you have it in your file. I know
Alrighty.
some, just I guess I know some PLP lenders just send a simple email or note, say, hey, we're going to readvance, and that just keeps FSA up to date, but it's not required.
All right, thanks, Tim. And while we have you off mute, we kind of have a follow-up that came into one of the earlier questions that kind of strays into servicing. So we'll just get your thoughts. And the question was, back to the question about the economic injury disaster loan. I guess maybe the question was more not so much when we're making a new guarantee, but what if there's an existing guarantee, and then I guess the bank, or at least the borrower, got an EIDL loan. And, basically, how would FSA handle that if somehow that EIDL loan ended up with lien priority in front of an existing guaranteed loan?
Well, I guess I don't know how it would have unless the bank subordinated their lien position, which typically we wouldn't want that to happen. So I guess, on a case-by-case basis is how we would have to look at that. But to me, I don't, I guess I don't think we would want to readvance if we are not in our perfected lien position that we started with.
Yeah, and that's something too we can always, perhaps try to get into a little more detail on when we put out the written Q&As as well.
Right.
So
yeah, that would be good too. We can work up something that might be a better answer at that point in time.
All right. So thanks, Tim. And I guess we'll move on to the next question here. And I guess, Steve, we'll start back with you on this one, and then I can certainly chime in as needed. So the question is, we sometimes see joint projects between multiple farmers. Is there an ability for a lender to obtain a guarantee on a project that involves multiple individual farmers?
We can look at that, but typically we would look at each separate operation if it's just a joint project. And I guess we'd have to look at that kind of on a case by case as far as, is this a joint operation where, it's an ongoing, operation, similar to a partnership, or is this just one project, or, one, farm or something that they are just operating together for this one piece of land. We do, need to separate and, keep our loans as, to the operator of a farm, and try and distinguish between, whether this is this a separate operation, or is it just one unique, project where two separate operations are both contributing resources to it. So anything else you can think of on that, Matt?
No, not really beyond what you said. Like you said, it's one of those situations where the devil's in the details in terms of, is it who's operating what? Are they truly operating separately, or are they operating together? So it's just one of those we'd always have to look at kind of on a case-by-case basis. So real quick, there was just, which I can answer this, unless Steve, the answer for sure. Just the question was, if we know exactly where the copy of the presentation will be shared. I mean, I know we're going to. I don't think we've actually sorted out exactly where that's going to be located at or posted at, but we'll certainly make everybody aware when it is out there and available. But
yeah, hadn't thought that far ahead. I guess our website is always a good place to start.
But
and if it's a different location, we'll probably at least have a link there to, or instructions to point you where it is. So.
Right. And I would say this, similar to, how this training was announced, obviously once the presentation and the Q&As and all that stuff is available, obviously there'll be some notification to go out just to let everybody know, where it is and how to go about accessing it and so forth. So anyway, moving on to the next question. The question is, are unofficial entities that you mentioned, such as joint ventures, eligible to apply for loans? And if so, what documentation on the entity is needed?
Regarding joint ventures, I guess most of the joint ventures that we have, we call them, the similar term we have is a joint operation. It's I guess, possibly somewhat different. But for a joint operation, most of those that we have are, spouses. It doesn't necessarily have to be spouses. We can entertain if it's truly a joint operation. And again, this kind of gets into some of the details. Is it truly a joint operation, where, you know, everything's, run through this one operation and then a net figure is split out somehow at the end. Some of those details we would look at. The other thing just to keep in mind is all entity law is state law. And, whether that's, acceptable or allowed in your state, to have informal entities or not, could be impacted by your state law. So, I can't speak to that specifically. But as far as our regulations, yeah, we can consider, informal entities. We call them joint operations. And, as far as the specific details, just, as a description of, what the, what the details are, who's involved, what do they farm, how are the shares and assets split? I mean, just some of those details in the narrative or whatever separate documents, but that, can be included in the narrative, describing that and, that along with the loan application that describes who the members are, and that's definitely one where, paying more attention and a little more thorough description in the narrative would, really be needed. So, do you have any other thoughts, Matt? Did we lose Matt?
Nope, I'm sorry, I'm still here.
Okay.
After doing all this, I still haven't figured out that darn mute button, so it gets me every time. But anyway, sorry about that. So the first of those two environmental questions I had mentioned, for the next two we're going to address, I'm sorry, were just kind of environmental related, so I can take those. And the first question was just could we provide a little further definition to ground disturbance and large amounts of livestock in terms of reporting the environmental requirements. So as far as ground disturbance, generally what we're talking about there is disturbing previously undisturbed ground, below the plow layer. And we're talking about typically a change in land use as well. So, just to make a simple example, if it's a farmer, that's just going to do some tillage work in a field that's always been a crop field, no change in land use, nothing like that. Typically that's no big deal, no problem. But typically when we're talking ground disturbance, we're most times talking construction of something, where we're excavating down below the plow layer for previously undisturbed ground. And as far as large amounts of livestock, ultimately a lot of times what we're talking about there are the CAFOs, which I believe, I always get this acronym backwards, but I believe it's either confined or concentrated animal feeding operations. But either way, where we have those large amounts of livestock, and the exact threshold there, varies depending on the type of livestock. But those are typically the types of deals where you're going to get into the little more advanced environmental review. And in that review, which kind of ties into the second question, which is there still a requirement for a SHPO review, so a state historical preservation officer review on livestock facilities? And again, that kind of depends on the specific case, but yeah, I mean, typically anytime, we're building a structure or doing any kind of, ground disturbance like that, typically there is going to be a consultation with SHPO and probably some other outside agencies needed as well. And I did see, before I hand it back over to you, Steve, I saw one other environmental question here. So I'll just go ahead and jump ahead and grab that one before we switch back. And the question, this had to do with the environmental due diligence I was talking about. So this was switching back to suitability of loan security. And the question is, in a joint financing situation with FSA and a PLP lender, can FSA just do the FSA 851 and share it with the lender, instead of the PLP lender doing their own? typically we recommend that the lender still do their own due diligence review, just because, at the end of the day, you're still, have to sign the application form and certify that you've done a site visit and you didn't notice any environmental hazards. So, I guess you could try to rely on our review for that, but at the same time, it could kind of hang you out there if we missed something inadvertently. And like I said, typically that's, that burden, falls to the lender, because it's your, even though it's a security for an FSA direct loan, it's still security for your loan as well. So, generally I would recommend you still do your own. That's not to say you obviously aren't talking and, maybe comparing notes as you go, but, we would generally recommend that the lender still do their own in that case, just out of an abundance of caution. And keep in mind too, for those, for the FSA 851s, the lenders don't have to submit those to FSA unless they, find some sort of a hazard or a problem out there. I'll ask you this next one, Steve. And then I guess I'm struggling to understand it a little bit, but I'll read it to you here. So the question is, if we have a borrower that's looking to apply for an FSA loan and they are working with their county office, do they have a different process if they're working with a PLP lender? So I guess I'm not clear if they're, if it's somebody that has a loan with a PLP and they're applying for an FSA direct loan, or if they're just talking about applying for the guaranteed loan. I would start by saying this. Obviously, with the guaranteed loan application process, like our lenders know, the lenders apply to FSA on behalf of the applicant. So, there's really nothing different there. The lender's still going to apply for the guarantee on behalf of the applicant. Now, if that same applicant is also applying for, an FSA direct loan as part of a joint financing situation, that individual is still going to work with our local office just like they would for any other direct loan application. The fact that the lender's a PLP doesn't really change anything in terms of what the applicant would have to provide in terms of applying for the direct loan. But Steve, any other thoughts you want to add on that?
No, I think you nailed that one. So
okay. Now this one, just see if there's anything you want to add. It kind of ties into one that was kind of the first one we talked about as far as the benefits of becoming a PLP lender. So this is just kind of a follow-up to that in terms of, I guess we talked about the process of how you would apply for PLP status, but is there anything else, besides kind of what we've talked about in the session here today in terms of the benefits of reaching that PLP status?
The primary, I guess, two, primary benefits, on the loan making side, and also some additional in servicing. But the biggest thing on a PLP lender, for our other statuses, whether it's SCL or CLP, both of those statuses of lenders need to process a loan according to, the way we define it in our handbook. They have to process and underwrite the loan our way, projected cash flow, etc. The big difference with a PLP lender and what was designed, the program was designed around the philosophy of a PLP lender can underwrite and process a loan and gather the material their way. They decide, and this is all in the CMS, but the PLP lender decides and tells us, here's what we're going to gather from the lender or from the borrower. Here is how we are going to analyze and underwrite it. And we are going to give you the application and narrative as, what we submit to you. The rest we are saying we have it in the file. And that sums up the big difference for the PLP lender. Faster approval times, we got 14-day approval, 14 days from a complete application, or it's automatically approved. So our PLP applications are, approved faster by the nature of, we have less to look at and we're putting more on the lender. Again, the PLP lender is saying, hey, this is going to be on our file, and, they are committing to having that. When we go to review it, it would be in their file, but it's all according to their credit management system. And again, when you're working with us on this credit management system, tell us how you do your other loans. Try and make it as seamless and as, invisible as possible. That's, less for you to keep track of, as to what do I have to do because it's a guarantee. Well, if you just make it like you do your other loans, it's a lot less to keep track of. So that's the whole philosophy behind it. There are some advantages as far as, a little more authority on certain routine or servicing actions. You don't have to submit and wait for our approval for stuff also.
All righty. Well, thank you, Steve. So with that, we'll go on to the next one, which I can just answer real quick. The question is, what is FSA using for 2023 corn and soybean prices and cash flow projections? So just two quick comments on that. Like Steve mentioned before, for PLP lenders, you're not required to use, FSA's prices for those. But if you're just interested in what those are developed and put out on a state-by-state basis. So I would just recommend that you check in with your local or state FSA office to get that information in terms of what prices they're using and their projections for those. Like I said, as a PLP, you're not required to use them, but just if you're curious for a point of information, you just have to reach out to your state or local office there for planning purposes. For farm loans, we don't put out national prices for those. So we have a couple. Additional questions here that I guess one was a follow-up to a question we answered earlier about the appraisal. So just kind of clarifying when we were talking about when FSA pays for the appraisal. And I guess they were clarifying it was more a situation where it's part of like a participation loan with FSA, or they're part of a participating like through the direct down payment loan program. And in those instances, a lot of times, FSA for our direct loans, FSA does pay for the appraisal. So they were clarifying that is if there's a certain list of appraisers that can be used. And in that case, there are only certain appraisers that can be used if FSA is actually paying for it as part of a direct loan. Those appraisal vendors have to be under contract with FSA. So there are certain requirements we have to follow to make sure we're getting the appraisal from a vendor that FSA works with for those appraisals for the direct loans. So thanks for clarifying that, because obviously that did change the answer a little bit. Like I said, when it's just a guaranteed loan, obviously, like we said, it's up to the lender just to make sure it's a state certified general appraiser and that it's USPAP compliant. But if there's an FSA direct loan involved in the transaction and FSA is paying for the appraisal because of that direct loan, then yes, there are only certain appraisers that can be used. So thanks for clarifying that. Again, related to appraisals, the question is, again, with regard to the $250,000 threshold, the question is, what if the loan is right at $250,000? Would an appraisal be required? And the answer to that is yes. The way it's written is for loans, or wait a minute, let me back up. For loans of, the way the reg reads is as follows: for loans of $250,000 or less, the lender can document using an evaluation. So in other words, if it's $250,000 or less, you do not need the full-blown appraisal. But if it's anything above $250,000, then in that case, you do need the full-blown appraisal. And this one, Steve, I will let you take a stab at. I assume this is kind of getting toward the evaluation criteria for those loans that are $250,000 or less. The question is, our bank accepts tax assessed valuations. Is that something FSA would concur with? And again, I'm based on the context, I'm assuming that's kind of for those evaluations under for loans under $250,000.
Yeah, I would gather the same thing. I know you will need to do more on the report for it, because there are other certain things that you need to have in the report, about, actually inspecting the property and what you need to include in the report. I guess I'm going to defer a bit on that one, because, it's been a couple of years since I've had a question on what's acceptable for an evaluation and what's not. So I'm going to defer a little bit, that we will include, a better answer in our written Q&As on that. as far as, whether that alone is acceptable. But I do know for an evaluation, you would at least need to add some things in as far as the report on that, but that, I guess we'll give a more thorough answer as to whether that alone is an acceptable method for an evaluation. So.
All right. So the next one, what is the best practice regarding conditional commitment revisions? Should those be handled before or after loan closing? So I guess I'll throw out my initial thoughts there, and Steve, you can feel free to add. But obviously, if there's a need for revisions to the conditional commitment, we definitely want to know about that before closing. Definitely better to try to address that, before all the closing documents show up. But understanding sometimes there's some things that are right last minute, maybe last minute small interest rate changes or something that may have to be addressed right when the closing documents come in. But generally speaking, if there's a need for any revisions to the conditional commitment, we definitely want to see that definitely earlier rather than later. So any other thoughts on that one, Steve?
No, I think you nailed that. So.
Okay. See, we have a couple other questions here, but I think they're pretty well, I don't want to say duplicates, but they're ones that kind of already been answered through some previous questions. So just bear with me here as I go down through. Again, there was a couple of them related to, well, I tell you what, we can take a stab at this one because this one, and I'll read it again to you. It kind of builds on what you were talking about before in terms of the ability to have an informal joint venture, joint operation. But I think there's a little different twist to this. So I'll read this one. So the question is, if brothers are looking to purchase some ground together, but do not have an entity attached to them, would you say they need to create an entity before applying for the guarantee, or is it okay that they apply individually? So again, Steve, since you've been taking the brunt of these, I'll throw my thoughts and then feel free to jump in. The first thing we would really need to know there is are they farming together or not? Obviously, if they're farming together, if it's one big operation, then they would need to apply together. Now, like Steve addressed before, depending on any nuances with state law and so forth, they could potentially do that as a more of an informal joint venture, joint operation, or there may be situations where they'd have to again, because of state law, have to form a more legal entity. But either way, if they're one way or the other, if they're operating together, they're going to need to apply together. Now, if you do have a situation where there's two truly separate standalone operations, then they would apply separately. Although, that's one of those situations where FSA would probably be asking for some more clarification from you just to, ensure that we really did have two separate operations. But any other thoughts to add on that one without kind of rehashing the entity stuff you got into earlier?
Yeah, not to dig too much deeper, but the way I would look at it is, are they structuring this, in other words, as all income, all sales, all expenses, everything is thrown into one account, and at the end, the net income is shared somehow between the owners? Or are they just farming some ground together where they each take, their share of the bushels at the end and the expenses are split? We get some confusion as to, on that manner. So I guess that's the only other thing I would add is, a lot of this depends on the details, but that's one thing I would definitely take a step back and consider is everything all in one until the very bottom line, and then you get a K1 at the end, or are they splitting out the bushels? So.
Okay. So one other one here, again, just a follow-up clarification about the real estate appraisals in terms of whether does the appraiser have to be, an FSA approved appraiser, or can the lender use any state certified general appraiser? And so to clarify that, the distinction is who's providing the appraisal. If the lender is the one going out and ordering the appraisal, you know, and either the bank's paying for, or the lender's paying for it, or the lender's charging the applicant for it, you know, the lender can use any state certified general appraiser. Where it would have to be an FSA, not that I would use the word approved, but an FSA contract appraiser or an FSA vendor appraiser. That would be if it's a scenario where there's an FSA direct loan involved and FSA is paying for the appraisal by virtue of that direct loan being involved in the transaction. At that point, there's only a limited amount of appraisers that can be used. You know, the trade-off there is, though, obviously the lender and or the applicant doesn't have to pay for it. But again, if it's a scenario where there is no direct loan, FSA is not paying for the appraisal, then, you know, the lender can choose, you know, any state certified general appraiser out there. So hopefully that helps to clarify. And like I said, we can, you know, we'll make sure that's clear in the written Q&As when we get there. So the next one's just kind of a generic question, which is there any, you know, training available for just new lenders who have not worked with FSA before? Thoughts on that, Steve?
You know, we don't have anything formally. That was brought up in the Lender Summit as one of the requests, you know, of various training topics is, you know, something for new lenders, since we do have, you know, a lot of new lenders out there that are fairly, I guess, new to the program. We're going to do that. Yeah. You know, that's definitely on our short list of, you know, one of the training sessions to have is to create something kind of as basic training for new lenders.
Okay. And I would just add to that as well, you know, if you are new and just looking to learn more about the FSA programs, definitely reach out to your local FSA offices as well, because the, you know, the state and local offices also do their own localized lender training as well. So, you know, definitely reaching out to them and getting involved in some of that is definitely helpful to you as well, or would be helpful to you as well. And just a follow-up question as it relates to that was for experience guaranteed lenders. Can we replace the annual training requirements with a presentation like this? And Steve, correct me if I'm wrong, but I think the intent at this point was, you know, for these national webinars like this to not necessarily replace that local or state or local level lender training. This was designed to be more supplemental to that at this point. I mean, I guess depending on how that evolves over time, perhaps that might change, but at least as it stands now, I believe that was the intent, was it not?
You know, that was the intent. That's the answer we've given all along, but I would agree that's probably something we should take a look at to see, you know, if we want to let this count or not, or how we want to answer that going forward. So.
Okay, so that's one of those. That's the answer where we stand today. But you know, stay tuned down the line if that may change a little bit. Next one. This one deals with kind of switching the subject back into the meat of the presentation. So, can you provide an outline or description of kind of what's to be included in what might be a shortened narrative for lenders that might be using scorecard underwriting? Thoughts on that?
I guess one thing, a couple thoughts on that, and I'm sure you got a couple of your own. The description of the operation and the stuff that I went through, like on eligibility, that's probably where we need to make sure that's thorough, particularly with these scorecard. You know, some of the, when we're doing some of these PLP reviews, we see samples of what a lender would use for their scorecard narrative. And that's probably the area to really focus on, is make sure that description of the operation and addressing these, the big three eligibility stuff is thorough enough for us. Now, the differences on the capacity, that's going to be, you know, likely shorter. You know, we would like to have something show, you know, just talking through, you know, supporting, you know, in, you know, a paragraph or whatever that, you know, this loan qualifies for your scorecard underwriting. Here's how it's scored out. You know, here's what our threshold is. You're probably not going to have a whole lot more than that on, you know, the capacity. That's probably going to be the big area of difference. You know, you're still going to need to describe the collateral, you know, credit history somewhat, but the biggest difference is probably going to be, we do recognize your capacity discussion is going to be shorter and more abbreviated. Any spin on that one?
No, I mean, again, like you said, at bare minimum, obviously, we still need to cover all the basics to, make sure FSA has the info we need to make that decision. Is it, do we have enough documentation to know that it's fully secured? That we are comfortable with the capacity and the capital position and whatnot. Do we have those different eligibility bases covered that Steve was talking about? So yeah, understanding particularly the capacity analysis and even to an extent the capital analysis is going to be more brief. We still want some discussion of that for sure. And then, like I said, it's just a matter of finding that balance to make sure there's understanding it is an abbreviated underwriting process for the lender, but at the same time, just making sure from the FSA side, we, have at least everything we need to be able to make an approval decision. So the next one, the next question is, when renewing PLP status, will the 20 loan in 5-year requirement remain in place, or is there any thought to adjusting that number for whatever reason? And I guess I'll give some thoughts on that. And then Steve, again, feel free to jump in. I can tell you part of the lending summit effort that Steve mentioned earlier. One of the recommendations was just, taking a look at kind of revamping the PLP program in general. And of course, as part of that conversation is, that loan volume threshold, whether that 20 loans in 5 years is still, still a good mark or not, or, should there be a difference, between lenders first initially applying for and obtaining PLP status versus renewing it. So there's been some discussions around that, but no decisions made at this point. So, I mean, as it stands today, that 20 loan in 5-year threshold still applies across the board, whether it's a new lender applying for PLP status or existing lenders renewing it. But, the topic has been brought up, as something to consider. So any other thoughts on that, Steve?
No, I mean, we have done some very preliminary analysis on our data, to try and re-support that's the right place to set it. It's been a long time. We recognize that. And that's one of our efforts this year is to go through and either support that it stays or consider how should we tweak it. So.
Okay. So just for the sake of time, then we'll move on to the next one. I guess in this lender's area, they feel like FSA maybe doesn't have enough lending staff around. The question is FSA trying to shrink the lender workforce, or is there a plan to staff each county office? What I can tell you is there's no plans to our knowledge to shrink our workforce. Now, that being said, we've, have the same trouble as, a lot of businesses out there just trying to find people to fill those vacancies. And, sometimes we bring people on, we train them, and then they move on to other opportunities. So, I mean, that's an ongoing struggle to keep up with staffing, and keep those levels up. And I know that's something that, leadership's continuing to try to address, but I'm certainly not aware of any efforts to cut back staff. It's just the opposite. It's trying to, recruit and retain more people, that's for sure. So, let's see. I guess if we still have Tim on the line, we can switch over. Here's a servicing one just to mix it up. So the question is, if a PLP lender has guaranteed lines of credit that were initially made when they had CLP status, how would they handle the request to readvance in subsequent years? So I guess, in other words, the lender status has changed after that loan was made. So if they're now a PLP, but it was originated as a CLP, how would they handle that readvancing on the line?
Yeah, they would be under the PLP status, and so they would handle it under how they're required to, either through their CMS or if it identifies how they're doing it, or basically they document it and have it in their file, but they would follow the PLP status.
All right. Thanks, Tim. And the next one kind of strays loan making and servicing, so feel free to chime in on this one too. So the question is, for lenders that have an existing guaranteed line of credit now, 5-year line of credit, they're anticipating a need for, additional operating money during that 5-year term. So basically asking how that process would work. So basically, if you have an existing line of credit and you know that the ceiling is not going to be high enough to meet the need going forward, what do you do? Essentially is the question. So at that point, what you'd have to do is you'd have to submit a new application for at least whatever the additional amount is. So, say for example, your existing ceiling or your existing line has a ceiling of say $1 million. You feel like moving forward that ceiling needs to be say 1.5 million. You'd have to come to FSA. You could submit an application for that additional amount, so that additional 500,000, and then afterwards, after closing, you could essentially, so for a time you would apply for a second line of credit, but then after closing, you could potentially look at consolidating those into one larger line of credit. So a lot of times that's what lenders will do. They'll come in and apply for whatever that additional amount is, close that, and then try to consolidate them after the fact. Of course, there are a few requirements we have to make sure we're met in terms of the consolidations, but that's typically what we see. The only other thing to keep in mind there is, say you're still tied to then whatever the term of that original line of credit was. So, doesn't mean when you get to that new higher amount that would be another 5 years if you choose to consolidate them. If you choose to consolidate them, you would be tied to, the maximum maturity would be tied to, the original line. So, Tim, any other thoughts from the servicing perspective on that one?
Nope, I don't think so. The only other thing would be, maybe if you get towards the end of the year and you're out of money, we could look at doing or allowing emergency advances if your line of credit's out. But we don't want to start, using emergency advances where you're going to need it the next 3 or 4 years. You really need to, maybe a 1-year deal, but typically, like Matt indicated, you probably need to apply for an additional line of credit to meet your needs.
All righty, thanks, Tim. Just real quick, we have gotten another couple questions about the slides, and again, they will be made available in the near future once we have the Q&As and everything compiled. So we'll certainly let you know when they are available, but they will be made available. There was a question here that just seemed to be asking about our turnaround time for direct loans. That's really all the question said, so I don't know exactly what it was asking. Obviously, turnaround times for those are going to vary on a whole lot of factors, depending on, caseload, staffing. Is the application complete when it came in? Is it not? Like always, we try to process our applications when they come in as quickly as possible, but it's those timeframes can certainly vary just depending on the individual case. But again, it's kind of hard to say much more on that because like I said, the question didn't. Oh, let's see. There's a follow-up on that. What should the turnaround time be on direct loans? Again, it's, obviously the goal is to turn around as quick as possible. But, for example, the applicant has 30 days to provide a complete application. So if they, take that full 30 days, it's going to take a little longer versus if they provide everything complete up front. It's going to vary depending on if, an environmental review, like we talked about earlier, or I should say a more advanced environmental review is needed. It's going to vary on, again, just a lot of different factors like that. So, obviously, again, the goal is to try to get them turned around as quick as possible. But again, just have to understand that does vary. Okay, just a couple more here, and then we're about done, looks like. Here's an interesting one, Steve, kind of as it relates to tests for credit. Can we apply for a guarantee for a borrower if the borrower would potentially qualify for the Farmer Mac 1 program?
You can. We don't tie our eligibility or test for credit to, Farmer Mac's criteria at all. But again, they got those are pretty good quality loans. So you would have to somehow support to us, and that'd probably be, a case where we would expect to see more support in the narrative. As to, okay, what's the reason you're applying for a guarantee? You got to give us a specific reason that is related to a weakness in the loan.
Yeah, and just to echo that, that's why, the Farmer Mac 2 program is generally the one for the FSA guarantees, because there's obviously different criteria there. So, like Steve said, it really come down to if you could really document, if there was still a weakness there, you could document despite the fact that it met the criteria for Farmer Mac 1. So we have a little bit of a security lien position question here. So the question is it preferred to have a shared first lien or to have separate collateral when doing an FSA guaranteed loan and a bank loan at the same time? So I guess just my initial thoughts there. I mean, some of that comes down to where we're at loan to value wise. Typically on real estate, an FSA guaranteed loan can be in a junior lien position as long as the loan to value doesn't exceed 85%. So if the numbers work out that way, the unguaranteed loan could be in a first lien position. The FSA guarantee could be junior to that. But if the numbers are such that loan to value exceeds 85%, then a shared lien may be the only option there. So that is something, we can consider again on real estate. The rules are different when we get into chattel security, but for real estate security, if that 85% loan to value rule isn't met, shared first lien is something we can look at. So, it's not that there's particularly a preference either way. I guess it just really comes down to, whether it meets FSA's junior lien requirements or not. So, any thoughts on that one, Steve?
No, generally agree with you.
So I do see there's, this is one that we'll try to, provide some better guidance on in the Q&A documents when it comes. But I guess just clarifying back to that question about the EIDL loans, the economic injury disaster loans. Apparently, there's some wording in those documents that causes future advances from anybody to fall into a junior lien position or in a lien position junior to SBA. So, that being said, I know there's been some discussion around that in terms of our FSA direct loans. Again, typically when it comes to lien priority and maintaining lien priority, generally for a guaranteed loan, that burden's a little more on the lender than FSA, but when we get to the written Q&As, we can certainly try to, provide a little more clarification there. It looks like we have one more here. So let me just look at this to see if it's one we've kind of answered already or not. Let's see, I'll read it to you here, Steve, and then you can take a stab at it. And this may be one we can get into a little more detail on when we get to the written Q&As as well. But the question is, when refinancing a USDA loan, I'm assuming an FSA guaranteed loan, for equity extraction on a farm property, if the underwriting meets FSA's criteria, can the existing guarantee be retained?
I guess I'm not sure on the answer to that. We'll have to kind of defer that one to our written Q&As.
And again, if for whoever asked that, if there's, like you say, Steve had provided his contact info there before as well. So if that's something, you want to reach out separately on with maybe a little more detail so we can just be clear on what you're asking, you can certainly do that as well. So with that, I believe that takes us to the end of the questions that we received. Other than I will just say this, I did see there's a few questions in here in terms of the Inflation Reduction Act and next steps there. We didn't answer those simply because we don't have the answers to those at this point. Best we can tell you is similar to earlier actions that were taken under the Inflation Reduction Act. You'll see, communication from the broader USDA department when the time comes, and obviously that'll be shared by FSA leadership when the time comes. But at this point, we don't really have anything else to share there. But just stay tuned. There will be more information coming. We just don't have it right at this point in time. So with that, like I said, Steve, I think that takes us to the end of our questions. So just any other last closing remarks, thoughts you have before we wrap up?
I'd like to just thank everybody for attending. It's been some time, and we recognize it's kind of long overdue to start doing these joint trainings again. We will continue. Certainly, let us know if you have any ideas for future topics. So thank you much.
All righty. Well, thank you very much, Steve. And again, thanks to everybody for joining us and participating today. And at this point, we're going to go ahead and end the live event. Thanks.